Welcome to the Northbound Wealth Podcast. All opinions expressed by me, my co-hosts, or my guests are solely our own opinions and do not reflect the opinions of Northbound Wealth Management. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast. Hey everyone, this is Brent Foster. We got a lot to go over on this week's weekly market insights. Stocks retreat despite solid earnings. So today is October 23rd. Rising bond yields and uncertainty over whether this was the close of the Fed's rate hike cycle dragged markets lower last week, despite solid corporate earnings results. The Dow Jones Industrial Average sank 1.61%, while the S&P 500 fell 2.39%. The NASDAQ Composite Index, which has led for most of the year, slumped 3.16% last week. The MSCI EAFE Index, which tracks developed overseas stock markets, retreated 1.67%. So what does that mean for the Dow? The Dow closed at 33,127. That's basically down slightly on the year, 0.06%. The NASDAQ closed at 12,983. That's up 24.05% for the year. MSCI EAFE Index closed at 1,978. That's up 1.80% for the year. S&P 500 closed at 4,224. That's up 10.02%. 10-year Treasury note actually closed at 4.93%, nearly 5% bogey that I've been talking about. So what's interesting about all of this is if you bought treasuries at the beginning of the year and just were rolling 3-month, 9-month, and 1-year treasuries at 5%, you'd be doing quite well. The S&P 500 and the NASDAQ are the only two indices actually beating you, and treasuries offer guaranteed return on that if you hold them to maturity. So it's an interesting market. I think you take a barbell approach. Own treasuries and also own equities, because after all, the NASDAQ, which is represents large tech companies, a lot of large tech, it's up 24% this year. I mean, that's awesome. And then the S&P was up 10. I mean, that's great too. So rising yields sink stocks. Stocks rallied to start the week on earnings optimism before losing momentum over the rising bond yields. Yields rose after traders speculated that strong economic data might persuade the Fed to raise rates. By midweek, stocks turned lower as the 10-year Treasury yield moved above 4.9% for the first time since 2007, while mortgage rates hit 8%, the highest level since mid-2000. Stocks were under pressure Thursday as the 10-year Treasury yield moved closer to 5% in response to comments from Fed Chair Powell that inflation remained too high. With the 10-year Treasury crossing above the 5% mark on Friday, and ahead of a weekend of uncertainty in the Middle East, stocks weakened further, ending a down week on a sour note. Economic strength, housing weakness. So the economy continued to show surprising evidence of strength, according to data released last week. Despite worries of a struggling consumer, consumers increased their spending as retail sales rose 0.7% in September, well above the forecasted 0.3% rise, while industrial output jumped 0.3%, exceeding the forecast of 0.1% gain. There was also updates on housing and the state of housing. Housing starts rebounded 7% from August, though permits, that's permits for new home builds, an indicator of future housing starts, declined 4.4% month over month. Existing home sales were weak, falling 2% from August and 15.4% from a year ago. Existing home sales are on track to record their slowest year since 2011. Woo! Okay, key economic data. Tuesday, PMI. Wednesday, new home sales. Thursday, GDP, or gross domestic product. Durable goods orders, jobless claims. Friday, personal income and outlays, and consumer sentiment. And again, we get a lot of that data is derived from the Econ Day economic calendar, which lists upcoming U.S. economic data releases. and including key economic indicators, Federal Reserve policy meetings, and speaking engagements of Federal Reserve officials. There you go. Notable companies reporting earnings. There's a slew of them, and we'll be tracking all this data very closely. Tuesday, Microsoft, GE, Verizon, Alphabet, which is also known as Google, General Motors, the Coke Company or Coca-Cola, 3M, Texas Instruments, HCA Healthcare, big healthcare, Next Era Energy, Kimberly-Clark, Sherwin-Williams, Danaher, and Pulte. Wednesday, the Boeing Company, IBM, ServiceNow, Thermo Fisher, General Dynamics, O'Reilly Automotive, and T-Mobile. Thursday, Amazon, Intel, Ford Motor Company, MasterCard, Merck, Northrop Grumman, UPS, Comcast, Honeywell. Friday, AbbVie, Exxon, Chevron, and Colgate Palmolive. There you go. The gig economy tax tip. This is your tax tip of the week. There are some essential tips to remember if you work as a gig worker. All income is taxable. There you go. Regardless of whether you receive information returns, including full-time and part-time work and those paid in cash. As a gig worker, your classification is as an employee or as an independent contractor. This can depend on where you live, even for the same services. Lastly, it's important to remember to pay the correct taxes on this income throughout the year to manage owing additional taxes when you file, because gig employees don't have an employer withholding taxes from their paychecks. They can either submit a new W-4 or have their employer withhold more from their pay if they have another job as an employee, or make quarterly estimated tax payments throughout the year. And again, this information is not intended to be a substitute for specific individualized tax advice. We suggest you discuss your specific tax issues with a qualified tax professional. And these tips were adapted from irs.gov. All right, here we go. Boost your productivity with these tips. Take regular breaks. It seems counterintuitive, but most people are more productive when they take frequent breaks. Do the challenging tasks first. Mark Twain famously said, "Eat the frog first thing in the morning," meaning you should tackle your most difficult task immediately. Make 2 to-do lists, not 1, but 2. 1 with your weekly goals and objectives and 1 with your daily tasks. Divide large projects into manageable steps. So break things down, make them digestible, make the things on your to-do list specific so you can continue to cross things out and make progress. These tips were adapted from FormStack. Good stuff. I thought I'd share it on the podcast. All right, on to the next segment. Stay tuned. I got the October issue of the 2023 AAII Journal. And in it, I found an interesting article that I'd share with you. It's an educational piece, how-to section. It's on page 16, and really appreciate this. Using EBITDA and enterprise value to calculate a stock's worth. So one of the key financial metrics that investors often encounter in EBITDA, this acronym stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is a valuable tool for assessing a company's financial health and profitability. What is EBITDA? Well, EBITDA is the most often used as somewhat of a proxy for operating cash flow, providing insight on the probability of a company's operating decisions by looking at its core operations. It is pronounced by most as EBITDA, but regardless of how you say it, EBITDA is independent of capital structure. It excludes financing decisions made by management, tax rates, and non-cash items, which do not directly impact operations. EBITDA ignores depreciation and amortization because they are non-cash expenses. So depreciation reflects the gradual loss in value experienced by fixed assets, such as buildings and equipment, through age and wear and tear. Amortization expense is used to account for the deterioration in value over time of intangible assets, such as intellectual property and goodwill. Taxes and insurance are ignored because some argue that these elements are not related to the company's main business operations. Not only do tax rates vary by location of the company, but tax expenses are also influenced by the decisions a company makes regarding possible deductions, credits, carry forwards, and the timing at which certain transactions are recognized. Why would a firm discuss earnings using this measure? It's a good question. Companies like to report or emphasize EBITDA instead of earnings based on generally accepted accounting principles or GAAP when they have large amounts of debt and high depreciation costs. A good EBITDA can signal that funds are available to support and pay off debt. Industries that require high amounts of capital, as well as companies with a high level of intangible assets, may prefer to use EBITDA, especially if they have low or negative GAAP earnings. Low or negative earnings make it harder to compare some industries on an earnings valuation basis. Companies utilize depreciation to expense the cost of property, plant, and equipment, or PPE, or capital investments. For example, telecommunication companies have high depreciation rates on their capital investments, coupled with high interest payments on debt used to finance their investments. Companies such as these can have negative GAAP earnings, whereas EBITDA figures report the earnings available for debt payments and place earnings on high enough on the income statement to create positive figures necessary for valuation models. So, calculating EBITDA. EBITDA simply takes net income and adds back expenses that were previously deducted. An easy way to remember that EBITDA represents is that net income includes these expenses while EBITDA excludes them. EBITDA equals net income plus expenses of interest, taxes, depreciation, amortization. Add up all the income statement line items that are expenses or subtract any line items that are income and add the total to the net income or net loss figure. You can easily calculate EBITDA using a company's annual Form 10K or quarterly Form 10Q reports. EBITDA may also be reported in company press releases, which all members can access through AAII's journal, or it's something that we access here at Northbound Wealth Management through our Schwab portal and our trading platforms. Combining EBITDA with enterprise value. The enterprise value to EBITDA ratio, also called the enterprise multiple, is one metric that can be used to determine the value of a company. The enterprise multiple is enterprise value divided by EBITDA, and it looks at a company the way a potential acquirer would by considering the company's debt. Enterprise value is a stock's theoretical takeover price. If a company were to be acquired, the buyer would have both the company's equity and its debt while being able to pocket the company's cash. It differs from market cap or market capitalization, which only considers equity. Therefore, many believe that enterprise value gives a truer value of an entire business since price-based multiples look only at the equity of the stock. So they have some tables on here and you can go do some stock evaluators. I'm going to skip all of that, but basically investors mainly use a company's enterprise value to EBITDA ratio to determine whether a company is undervalued or overvalued. A low ratio relative to peers or historical averages indicates that a company might be undervalued, and a high ratio indicates that a company might be overvalued. So we use a bunch of screeners to evaluate that actually here at Northbound. And we look at various models and analyses to figure out if we want to get into a stock name or not. So here's some drawbacks and criticisms of EBITDA. So while EBITDA is among the most widely used metrics in corporate finance, there is a disagreement as to its true value. Some investors feel that examining a stock's enterprise value relative to its EBITDA is a superior method of measuring company value, since the enterprise multiple is indifferent to the company's capital structure and capital expenditures, or CapEx, which can be altered as needed by management. Warren Buffett is one of the most prominent voices against using EBITDA for valuation, believing that the impacts of CapEx and changes in working capital should not be neglected when understanding a company's financial standing. EBITDA can be used to analyze and compare profitability among companies and industries, as it eliminates the effects of financing and accounting decisions. However, EBITDA is not the same as other metrics, such as net income. Interest, taxes, and non-cash expenses have real financial implications that cannot be totally dismissed when analyzing a stock. It is also important to note that EBITDA is not a GAAP measure, and therefore it is unregulated. That is a key point, by the way, that this article, I'm glad they're pointing this out. I like to look at GAAP as well. So the figure can be manipulated to make a company's stock look more profitable. So that's EBITDA. It can be manipulated by accountants. If the calculation method remains consistent from year to year, however, EBITDA can be a useful metric for comparing historical performance. I want to give credit to Jack Gilleland, AAII's assistant financial analyst, for writing that piece. And I found it very informative, timely, as we're in the throes of earnings season, and there is a ton of data coming out on companies about their earnings and about how much money they make. And the appetite for stocks right now is to buy companies that are actually making money and have good business models. And so that's why you see quality factors go up during times like this, where financial statements are being analyzed and scrutinized all the more. And you see that reflected a lot in their stock prices and valuations. That is something to consider as we head into more and more earnings and as the year end progresses. Also listening to guidance on what a lot of analysts are saying and what the CEOs are saying, even about their own companies, about what they might guide for 2024, and making decisions going from there. So thanks for listening to the Northbound Wealth Podcast. Like, subscribe, and we'll talk to you soon.